Hey everyone, welcome back to Corporate Decoder, folks. The place where we turn confusing company reports into something you can actually use. Today we're diving into a report so packed with numbers the accountants probably needed sunglasses to read it. Just kidding, a little. This filing is a treasure trove of information about a group of investment funds, but what does it all mean for you? Let's find out what's really going on. By the way, before we get started, if you're into making sense of complicated financial info, make sure to hit that subscribe button. Also, join our Discord community. There is a link in the description, so don't miss out. Okay, let's start by stating the obvious. Each of these is basically a report card for how your money is doing inside that fund. I know, riveting stuff. We're talking about things like fund costs, performance compared to the market, and what exactly your money is invested in. Basically, you can find out how your advisors are doing in managing your investments. Let's start with Dana Epiphany Equity Fund. Alright, jump straight to the important part. First, check the name of your class, then see how much would $1,000 cost you. This is the important part. For the institutional class, it's $41. And how much in percentage would that be? Only 0.85%, very reasonable. These numbers are based on a hypothetical investment, but it gives you a good idea of what portion of your money is going towards fees. So what does this fund actually do? Well, it invests mostly in technology at 33.1%, with very big investments in Apple, Microsoft, and Nvidia, and a smaller portion invests in consumer discretionary and healthcare. The top 10 holdings make up around 36% of the entire fund. Keep in mind, past sector performance isn't a guarantee of future gains. That's good news to know. It means that they didn't rock the boat during the period. What about Dana Epiphany Small Cap Equity Fund, though? Okay, let's go straight to the cost again. For the institutional class, it's $44. And how much in percentage would that be? Only 0.95%, still great. For the small cap, it's completely different than the one we looked at before. The money now mainly invests in financials and healthcare. No one company accounts for more than 2/3 of your money, so it's very diverse, and it invests in much smaller companies. In this case, they also didn't rock the boat during the period. Alright, how about the next fund? Dana Large Cap Equity Fund. The institutional class would cost you $37 and it would be 0.75% of your money. Let's see what the money is invested in. It looks like a similar situation than the Epiphany Equity Fund, but with an even bigger focus on a technology sector, now over 32%, while slightly reallocating funds into financials. Once again, Apple, Microsoft, and Nvidia accounts for a significant portion of the money. It's $49 at exactly 1%. It looks like, again, almost exactly the same to the previous funds since they're exactly the same. Still, this is quite important because depending on how you invest, certain classes might be more expensive. Now for something completely different. The Kovitz Core Equity ETF is a whole other beast. They actually have something to say about how they performed. Essentially, while everyone in general took a hit, the fund's financial sector holdings did pretty well. Here we have another financial table. It gives the whole story. If you invested in this fund many years ago, how much would it be now? As you can see, if we invested 10K in 2011, it would be valued at around 42K now. While this sounds great, the most direct competitor, S&P 500, would net you 56K for the same investment. Also keep in mind that you should check previous year's statements to see how the ETF trended over time. To actually understand the average performance, Rifleman would net you 56K for the same investment. Also keep in mind that you should check previous year's statements to see how the ETF trended over time to actually understand the average performance. Again, financials and consumer staples did well, while on the other hand, healthcare, consumer discretionary, and industrials actually didn't do hot. One thing to keep in mind is for an ETF, it's quite small with only 37 holdings overall. No material changes again, but at least the advisor says it's focusing on what they believe are exceptional business at reasonable prices. Now for the Slow Capital Growth Fund. What does it actually do? It seems like this fund took a beating in the reported period, trailing its benchmark index significantly. The report blames heightened macro uncertainty and the actions of the Federal Reserve. Yikes! Looking at their track, it looks like investing 10K in 2024 means having around 9K now. This is also even worse than the target market index. However, they didn't lose faith and kept the portfolio largely unchanged, pointing to durable fundamentals and constructive earnings results. While communications performed well, technology, especially Nvidia, was a drag. So you have strong convictions if you have to believe on this fund's advisor. That technology sector also accounts for 42% of the entire portfolio, a very risky bet. Okay, no major moves, but with losses this big, I would think they would do something. But hey, they believe in it, and it mentions the fund is focused in exceptional businesses that can compound in value over time. It might be that they only recently started investing, so perhaps it's part of their strategy to suffer on the short term to get into the long-term investments. Next report, the SMI Dynamic Allocation Fund. From the looks of it, everything is going well with gains of 4.51% thanks to gold, as all US stocks corrected sharply during the same period that this ETF did. Investing 10k in 2015 means you make 13 now. This is significantly less than S&P 500. While they talk about enhanced approach over the last year, in general they had very short allocation to US stocks, which are usually a reliable return. Also, their advisory fee is quite high. As we can see for the top 10 holdings, most of the money is invested in Sprott Physical Gold Trust, Ceres MCIF EFEPF, and a SPDR Bloomberg 1 3-month T-bill ETF. Apparently the expense limit was not renewed. This might be a cause for concern. Lastly, we have the SMI Multi-Strategy Fund. What this fund does is essentially a portfolio by weightings, 50% dynamic asset allocation, 40% stock upgrading, and 10% sector rotation. They were favorable to S&P index. However, this strategy makes gains from gold as well as foreign stock. Similarly to Dynamic Allocation Fund, investing 10k in 2015 nets you 16k now, which actually is quite low considering market averages such as S&P 500. The weightings of the major holdings is SMI 314 Full Cycle and Sprott Physical Gold Trust. The holdings also make it similar to the Dynamic Allocation Fund's strategy. Also, they make a very interesting point that long-term value are being seen increasingly, even in what others might think is over-investing. There we have it. Expense limit was again changed. But overall, what do all these funds actually tell us? The first few funds invest in very standard fashion and give reliable returns if you believe in the indexes. Also check on those expense levels for each class. Always look for the class with lowest fee. Other funds here have a slightly different bet and perhaps will net more results long term, but they seem to underperform. So that was a lot of information in a short time. Now for the big question, if given the choice, which road would you go down? Let me know in the comments. Before you go, if you learned something today, hit that like button and subscribe to Corporate Decoder. Don't forget to check out our Discord server in the description to share some thoughts with other people too. See you at the next video.